In this screencast, we're going to look at some approximate profitability measures that we could use to determine whether or not a venture would be something you would invest in and move forward with in a profitable manner. And so the following example, we're going to look at a number of different types of analysis, including what we call the ROI or return of investment, as well as the payback period. And we'll also touch on what's called venture profit. Now, the three methods that I'm going to show in the screencast will disregard the time value of money, that of inflation, and the fact that we could invest the money elsewhere and make a profit on the investment depending on what the rate of return would be. So this is just going to be, again, approximate profitability measures using information that is pretty basic to the creation of some kind of venture. So let's look at the following example where we have a chemical plant that is built and we're told to use straight line depreciation methods. Depreciation is the reduction of the value of an asset that you have. In most cases, depreciation is something that you could use as a write-off on taxes. We're told to use straight line depreciation, and we have a fixed depreciable capital investment of $24 million that has a lifespan of 8 years. Now, our annual cost of sales, which excludes depreciation, and revenue are expected to be $6 million and $18 million respectively. Our working capital could be assumed to be 15% of the fixed capital costs, and our tax rate is 37%. There's no salvage value for the fixed capital, and our minimum return on investment is 20%, which is pretty high, but we'll use this as a comparison for the investment. So as I mentioned, the first thing we're going to look at is ROI. And ROI is the return on investment. It's also called the ROROI, which helps kind of make some sense of this. It's the rate of return on investment, whereas an ROI kind of makes it sound like it's a certain dollar amount. The reality of it is it's a percentage. It's the idea that we can calculate how much we make in profits a year based on our original investment. So that being said, we would want to calculate our after-tax earnings, or our ATE, and this would just be 1 minus the tax rate times our sales minus our costs. And this would give us our net profit after taxes. Now this is one point that gets a little tricky, is this cost depends on whether or not we are accounting for depreciation. So we're told in the problem statement that the annual cost of sales excludes depreciation. So this is just our costs. So we would write this in as $6 million, except our depreciation is our loss in assets. So we would have to account for that as an annual cost. To determine our straight line depreciation, we would take the total fixed capital investment of $24 million and divide it by our lifespan, which is 8 years. So this tells us that we have $3 million a year that our capital investment is depreciating. Our cost would be the $6 million plus the $3 million a year. Now our sales, we're told, is $18 million a year, and the tax rate is 0.37. So if we plug in these numbers into our equation, we get an after-tax earnings as $5.67 million a year. So to determine our ROI, we need to determine our total capital investment, so how much we spend to create this chemical plant. And so this is going to be our $24 million plus what we need for our working capital. And this is just 0.15 times our 24. And when we calculate our CTI, we get 27.6 million. So our return on investment is how much we're getting a year, 5.67, divided by our initial cost. And this gives us a value of 0.205, or 20.5%. So based on these numbers, what it's telling us is if we took the money, the $27.6 million, and invested it with a return on investment of 20%, it would actually be more profitable to start the company and build it because our return on investment would be 20.5% a year. Now, one disadvantage is that this does not take into consideration scale of the venture. So this could be a lemonade stand in which we have a return on investment of, say, 250%, which sounds really good, or it could be a billion-dollar project that might have a return on investment of 5 to 7%, which is still quite a lot of money coming in on a yearly basis. Another thing we're going to look at is what's called the payback period, or PBP. And just like it sounds, this is the amount of time it would take to get money back equal to the amount of money we put in at the beginning, or our payback time. And this is calculated very similarly to our rate of return on investment, but it's kind of the reciprocal, because we start with how much we invested, so the cost of our total depreciable capital, and we're dividing it by our net profit every year. But more so than just our net profit, we have to account for the depreciation that I mentioned earlier that kind of acts as a credit, since it becomes something that is reducing our costs. So here on the bottom, we're going to have our annual cash flow. And our cash flow is our after-tax earnings, which we already calculated. But now we're adding our depreciation back since it's retained by the company. And what I mean by this is it's almost like we subtract out our loss from our costs so that we're paying less taxes, but then we add it back in because we didn't account for that in our taxes. So our cash flow is how much money actually is coming in to our project. Now our cash flow could also be negative, could be coming in or out for our company. The actual money that's in is going to be $8.6 million a year. So going back to our actual problem here, our payback period, it's going to be our CDC, or $24 million that we are investing, total depreciable capital, divided by our cash flow. And you see that this is roughly 2.8 years. So 2.8 years after operating under these conditions, we have made back our investment. Again, this does not take into consideration the time value of money. This is a useful tool in determining whether something's worth investing in, because say the payback period is 10 years, there's a lot you could do with your money in 10 years, other options, other ventures, things that might come up that might be more profitable. Whereas if the payback period is a year, you know that if you invest in something, you're going to make your return on that investment within a year, and then after that, everything is kind of icing on the cake. And the last thing I'm going to mention is what's known as a venture profit, or VP. And it's defined as the annual net earnings in excess of a minimum acceptable return on investment. And what that basically means is that if we were to take our money and put it in the bank and get a rate of return of 20% of interest on that investment, how much in excess of that are we getting a year from this investment? So what's that mean? That means we go back to our ATE, and we're going to subtract out the amount we would get if we invested this with a return on investment of 20%. So we've already calculated our ATE is $5.6 million a year. We're just going to subtract out our TCI, which we also calculated earlier as $27.6 million, and that's both the total depreciable capital and our working capital. And this just gives us a value of $0.15 million, or $150,000 a year. So that's what we're getting in excess of what we could get if we invested at 20%. So unlike the return on investment, which is a percentage, this gives us an actual dollar amount that we could use to compare across investments. So hopefully these three approximate methods for determining profitability of an investment give you a quick basis on comparing different types of investments.